Hi, everybody, and welcome to my office hours. This is week 4 in ACC100, and I'm going to provide you with some highlights and insights from chapter 4 in the textbook, which is all about financial statements. I've essentially covered most of this in the 3 classes that we held in the last week, but I thought you might appreciate having a record of the issues that we highlighted. So the first slide that I want to share with you is this summary of how the different financial statements host data that we can use to evaluate business performance criteria specifically related to the assessment of financial performance and financial position of a business entity. In this diagram, you can see the 4 financial statements: the statement of financial position, also known as the balance sheet, statement of retained earnings, which supports the calculation of retained earnings in the equity section of the balance sheet, and the income statement. And what you'll notice, and then of course we have the cash flow statement. What you'll notice from the 3 statements that are enclosed in this fence of a dashed line is that the financial statement elements, assets, liabilities, equities, revenues, and expenses, have been highlighted. And in the statement of cash flows, the 3 types of activities, operating, investing, and financing, have similarly been identified inside this gray rectangle. This diagram also shows how the financial statements are interrelated, and that generates for us an order of preparation. So they must be prepared, firstly, the income statement, secondly, the statement of retained earnings, because the retained earnings calculation requires net income, which comes from the income statement. Calculating the ending balance of retained earnings satisfies the need for that amount in the balance sheet and the equity financial statement element. And then once all of these statements have been completed, accountants prepare the specific items that describe activities in each of these 3 classes in the statement of cash flows. If we add up the net cash flows from each type of activity, they will give us a net cash flow for the period for the entire enterprise for all activities. Adding that to the beginning balance of cash should give us the ending balance of cash, and that should agree with cash listed on the balance sheet. So these are the 6 items that you are required to know and will be assessed on out of chapter 4. This includes being able to identify what accounts transactions affect and how those accounts are associated with particular financial statement elements. The 5 that you are charged with knowing, which is assets, liabilities, equities, revenues, and expenses. Now, each of the financial statement elements occupies a block on a financial statement. You should know which elements belong in which financial statement. For example, revenues and expenses belong in the income statement because they are used to calculate income, hence the name statement of income. Assets, liabilities, and equities belong in the balance sheet. And activities, which are distinguished from accounts, belong in the income statement, and they represent the movement of cash. This idea here in point number 1 of sub-elements is a way of subclassifying the financial statement element into some meaningful groups. So typically, assets, for example, are divided into current assets, which are expected to be converted to cash or consumed or used within the next operating cycle of the business. Typically, that's 1 year. We also have other categories such as tangible assets or long-lived assets, which are tangible, as well as long-lived assets, which are intangible. So there are 3 or 4 different groups of assets. The one at the top of the asset side of the balance sheet is current assets. And within that group, within that classification, current assets, there can be listed a number of accounts such as cash, accounts receivable, and inventory. Likewise, the liabilities financial statement element on the balance sheet will be subclassified between current liabilities and non-current liabilities. Examples of current liabilities include accounts payable, salaries and wages payable, taxes payable. when we look at the cash flow statement, as previously mentioned, the monetary amounts that constitute data in the cash flow statement are grouped according to the nature of the activity that caused the cash to move. And those three activities are operating, investing, and financing. Financing activities typically bring financial capital into the business or are related to paying back the providers of that capital. Investing activities take that capital and, from the business's perspective, they invest it in long-lived productive assets. And operating activities are all the cash movements that are associated with day-to-day operations, such as making products, marketing and selling those products, and paying our employees and so on. Now, the financial statements are some standard financial reports which you are expected to be able to create based on your analysis of transactions and how they impact accounts and activities. So you're going to need to be able to prepare all four statements from being presented with a list of amounts, of account balances, and activity flows. We've already discussed the financial statement connections and the order of preparation. But as I mentioned in class, none of you are destined to become accountants, at least that you know of at this point in time. However, the real value from this course lies in its ability to help you evaluate financial information for the purpose of assessing a business enterprise's financial performance and financial position, because those impact how you or any other person as stakeholders will make decisions about engaging with the business entity. So in addition to those 6 items, I also recommend that you enhance your ability to create financial statements from accounts by knowing what accounts are associated with which financial statement elements. And I gave you a sample slide. You'll find it in the week 3 video, where I have associated all the accounts we encountered in some of the examples in the textbook with the different financial statement elements. Of course, to be able to create the financial statements, you need to know which elements go to which statement, and we'll go through an example in this video in a few moments. Of course, the next thing that you really need to spend some time on is perhaps struggling to some degree with reading and interpreting the financial statements that are ultimately created or already created and presented to you, in terms of understanding how the various business performance criteria, such as growth, profitability, cash flow, liquidity, and solvency, how those can influence our assessment of financial performance and how they can influence our assessment of financial position. Financial performance is typically impacted by our assessment of the business performance criteria of growth, profits and profitability, and cash flows. Financial position, which is like a financial health checkup, is influenced by the business enterprise's cash balances, liquidity, and solvency. We'll dig more deeply into liquidity and solvency as the course progresses. Now, the ability to evaluate or assess these concepts of financial performance and position is always enhanced by being able to compare the results of analysis of the particular enterprise we're focusing on with other benchmarks. And those could be the same enterprise's performance in a prior period. It could be that same enterprise's budget that it was trying to achieve, or it could be compared to other enterprises. And the last piece of advice I have for you, as you know from being in my class for 4 weeks, I strongly encourage you to learn how to use Excel. There are numerous resources available to help you do this. There are boot camps at the university, and there are all kinds of videos on YouTube that will help you develop these skills. Using Excel is a critical business skill, and if you can use it in this course, you'll find it easier to follow along with the demos I do in class. Plus, it will give you the benefit of being faster at answering the questions in your weekly quizzes on the exams and on the Super Quiz 2. And also, if you follow my recommended approach using checks and balances, you'll have less chance for error in your questions and a higher degree of confidence that you're getting the correct answers. All right, so the next thing we're going to do in this office video is I'm going to give you a demonstration of how we can use Excel to prepare or create the financial statements from a list of information that we're provided with. I started to do this with one of the sections, section 6. We got part way through, so we'll complete it in this video. So this is the Excel worksheet that we were starting to work on together, and it was addressing the in-class demo question number 4.2 about a business enterprise called Cellini DeVinto Lawyer. So this is a professional practice of a single lawyer. We were presented with this information, which is a list of account balances or activities. And we had amounts for each of these. What we did in the first part of the analysis, which was identical to what we did in question 4.1, we looked at the description and we tried to identify from the description whether this was an activity representing the movement of cash, that is a cash flow, or whether it was an account and the amount represented the balance, the accumulated balance in that account over the period. So you can see from this description that some of these items are, this represents a financing activity. The plus sign indicates a positive cash flow. The letter X represents an expense. A represents an asset. So office supplies were considered to be an asset because they have a probable future economic benefit to the enterprise. And we classified or subclassified this asset as current because we expected to consume or use the supplies within the next operating cycle, i.e. 1 year. Purchase of intangibles was identified as an investing activity. And because we're buying long-lived assets, it results in the outflow of cash. That's what this negative sign represents. In this example, R associates service revenue account with the financial statement element revenue. And these 4 columns identify which financial statement the particular account and financial statement element will be part of. So revenues are part of the income statement. Expenses are part of the income statement. Whereas investment activities and financing activities are part of the cash flow statement, okay? So that's how to read this table. And what I want to do next is show you, using Excel, how to quickly create the 4 financial statements. So each financial statement starts with a header block, which consists of the name of the business enterprise. So in this case, it's Cellini DeVinto Lawyer. Then we need the name of the statement, and all statements will be starting with statement of. So we might have statement of income, but I'm just going to leave it for the moment because I'm going to copy this and then edit it. The other thing we need for the statements is a date. And I think this was for the month ended April 30, 2021, if I remember correctly. All right. I'm just going to do a little bit of formatting where I'm setting these column widths to be standard. And now I'm going to start taking advantage of Excel's copy and pasting capabilities. So I'm going to take this generic form of a financial statement header, and I'm going to copy it and paste it into 4 other columns for these financial statements. All right. Now we'll go back and fill in the name of the statement. So the first one is the statement of income. The second one is the statement of retained earnings. So I'm creating these statements. The reason I'm referring to them as first and second is this is the order in which they must be prepared. The third statement is the statement of financial position, also known as the balance sheet. And the fourth statement is the statement of cash flows. Now, all statements except the balance sheet report the flow of something over a period of time, whereas the balance sheet reports a financial snapshot about the company's financial position at a point in time. So we're just going to date the balance sheet April 30th. And just for consistency, let me keep it as text. All right, so these are our statement headers. Now, the next thing I would suggest, which would be a helpful way to learn how these financial statements are constructed, is let's build a skeleton outline of the statements based on the names of the financial statement elements. So, for example, the income statement is home to the elements of revenues and expenses. And in fact, in this particular case, we're going to call these operating expenses. The statement of retained earnings doesn't have any sub-elements except equity. The whole statement is part of equity. But if you remember, I have described the statement of retained earnings as being in the format of a continuity flow. And that requires a balance of retained earnings at the beginning of the period. Then we add something that increases it, which is net income. And we know that comes from the statement of income. Then we subtract from it any dividends that were declared during the year. And we end up with a balance at the end of the year, okay? Now, if we look at the statement of financial position, what are the elements that comprise this statement? Well, firstly, we have assets. Sorry, we have assets. Then, why is this a different sum? We have assets. We also have liabilities. And we have equities. And on the statement of cash flows, we have operating activities. We have investing activities. And we have financing activities. So this provides the general skeleton of these statements. And the next thing that happens in terms of organization is that some of these statements have subclassifications. So, for example, under assets, we have current assets. And if we review what we've analyzed here, you can see that we've got as a subclassification, some assets are current and some are intangible, but I don't have any other subclassifications. And then for liabilities, I also have liabilities subclassified between current. And I guess that's it for liabilities. So let's go back to the statement of financial position. And we'll put in current assets, and we'll put in intangible assets. And then we'll put in current liabilities. All right, now that we've got this skeleton set up, it becomes a fairly simple matter to create these financial statements by simply referring through formulas to the data that's in this table on the left. So I'll demonstrate by starting with the income statement. So the first thing we need is revenues. And one of the things that we did in our analysis is we identified which of these accounts, we've identified which financial statement these accounts belong in. And we created these little check marks. So I can use these to help me populate the income statement. And in order to be sure that I've got every item that belongs in the income statement, I'm going to highlight these in yellow once I've used them. So for example, revenues, to pick up revenues, I'm not going to type anything at this point. I'm only going to fetch data from another cell. And what I need for revenues is anything in this column that is noted as a revenue with the reference to the financial statement element type R. And you can see that this one belongs on the income statement we've identified. So this is service revenue from the provision of legal services. So I'm just going to click on the account name, and you'll see that Excel very handily can use formulas for text as well as data. One thing I'm going to do right now is I'm going to set up a feature called freeze panes, which allows me to see more data. So let's freeze it here. And you can see on my Excel, I actually have freeze panes customized to be handy for me. But if you want to find it for yourself, you can go to View. And then over here, it says freeze panes, and click on freeze panes. Now I can scroll up and down, and the header is fixed. And I can scroll left and right, and my data is fixed. Okay. All right. Now, once I've got a reference to service revenue, you can see that over here in the table where I have service revenue, the very next item to the right of it is the amount. So if I drag this cell's formula into the cell to the right, I'm going to pick up that same amount. And now that I have picked this up, I'm going to highlight this data in yellow, just so I can identify that I've actually used it. And I think I'll highlight the check mark in yellow as well. You'll see why momentarily. All right, now to finish the income statement, I need to fetch from this table all of the expenses, all right, except for one at the moment, which is the income tax expense. I'm going to use that one later. All the other expenses I consider to be related to the business's operations. So I'm just going to pick them up in the order that they appear in the statement. I'll start with rent expense. The next one is website expense. I'm simply going down, looking at these check marks and looking for an X in this column. The next one is insurance expense. And let's just take those three for the moment and copy them into the cells to the right to pick up the amounts, and we'll just check them visually. Rent was $12.50, website was $20, and insurance expense is $175. All right, so I've dealt with these. Let's highlight them. Let's highlight the other ones. So that was rent expense, website expense, and insurance expense. All right, let's continue on looking for other expenses. The next one is telephone expense. Then I have utilities expense. And I'm going to leave income tax expense, but I have bank charges. And I have advertising expense. Is there anything else? That's it for expenses. So I now can copy these formulas over one cell. And if I just do a random check, we'll see utilities was 172. Here I see utilities 172. All right, so we picked up we already had insurance expense. We picked up telephone expense, which was this one. Telephone expense, we picked up utilities expense next, then we picked up bank charges expense, and then we picked up advertising expense. All right. Now, if we cast our eyes, oh, it looks like we missed one. We missed office supplies expense, which is above bank charges. So I'm just going to highlight these and drag them down and go and fetch office supplies expense. Now, how did I find that? Because I was casting my eyes up this column, looking to be sure I had picked up everything, and I had missed this one, office supplies expense. So that's why this technique of highlighting is a good way to ensure you get the right answer. It's a form of checking and balancing. So the office supplies expense amount, I'll just drag this over, and it's $310. Is that correct? Yes. Okay, so I'm going to use the format painter and copy the formatting from the utilities expense line to the operating expense line. That leaves me only one item that I wanted to put in the income statement, which was income tax expense. And the reason I've left it later is because remember we said when we have these blocks or groups of similar items in the financial statements, the whole activity of classifying or grouping is to keep similar things together. All of these expenses are controllable to some degree by the owner or manager of the business, but income tax expense is not. So what we're going to do here is we're going to add up using the sum formula all of the expenses that are operating expenses that are controllable by management. And I'm just going to use some formatting to signify that this is a total of everything above it. And I'm going to put a line on the bottom of the revenues to signify that that is the end of the revenues. If I had more than one line, I would probably create a subtotal. I don't necessarily need a subtotal for only one item. Now, the next thing we can do is calculate an intermediate level of income or profit, and we'll call this income before taxes. So that is the difference between revenue and expenses. So I can take revenue and subtract the total expenses. And then I can subtract my income tax expense, which was the missing item from the table. I just drag the amount over to the right. And now I can calculate net income, which is equal to income before tax minus income taxes. Okay, and I will put a thick bottom border on that. And now I'm just going to format these numbers using the comma, so it's easier for me to read. Okay, so here we have a completed income statement. I should just go back and copy the formatting that I used for the other expenses to the income tax expense. And you can see now, if we cast our eyes down the income statement column, we are confident that we have picked up every item that we analyzed earlier to belong to the income statement, because it was either a revenue or an expense. Now that we've completed the income statement, statement number one in our proper order, we can go and complete the statement of retained earnings. Since this was the first month of operations, there were no retained earnings to begin with, so the opening balance is zero. The net income comes directly from the income statement. So we can use a formula starting with an equal sign and refer to the cell where net income is calculated in the income statement. If we go to examine whether we have any accounts or cash flows related to the income statement, the statement of retained earnings, you'll notice this column is entirely blank. So there was no other information that impacted the statement of retained earnings, implying that there were no dividends. Okay. Now we can simply add up the three components that are required to get the ending balance. And again, I will format that with a solid bottom border. And I believe this is already properly formatted. Okay. We now have the ending balance of retained earnings. That's the conclusion of statement number 2. And we know that that belongs in the equity section of the income statement. So I'm going to type in retained earnings as the second component. And for the amount, I will just bring the amount from the statement of retained earnings. And there we go. All right. Next up, we need to populate the balance sheet with the various accounts and amounts. So the first thing we're going to do is we're going to go to the data list on the left, and we're going to look for anything that is an asset and classified or subclassified as current. Now I know, and you should know from this point forward, that the first item that needs to appear is the cash balance. So we're going to go over here and look for cash. Here it is here. The next one should be accounts receivable. Let's go look for that. Over here, we have accounts receivable. This is a legal practice providing services, so it doesn't likely have any inventory, but it might have some prepaid expenses and prepaid insurance. So let's see if we can find some of those. And to help us, we can go and look at items that are checked as belonging to the balance sheet. Office supplies is a current asset. Let's pick up office supplies. What else do we have? Website design, we classified that as an intangible asset. Accounts receivable, we picked up already. Cash, we picked up already. Prepaid insurance. So prepaid insurance and prepaid rent. These are other current assets. So let's pick up prepaid insurance. Oh, I have to go and set up a formula. So I need prepaid insurance. And I need prepaid rent. And then for each of these formulas, now that I have the caption, I'll just drag the amounts to the right. And you can see the formatting is a little peculiar because I've used this space before. So let's fix this. We'll change the alignment of these cells to be indented 2 characters. There. And this column will just format with the comma. So this is lining up a little better now, and we can create a total current assets. And I'll just indent that a bit. Now, hopefully this is the total and I haven't missed anything. I'm now going to use my sum function to calculate the total current assets for this business. And I will signify that it's a subtotal using some double lines. So I have 5 items. Let's check that we've got, the first one was cash, then accounts receivable. So cash, I'm going to highlight that since I've used it. And I'm going to highlight the check mark in the balance sheet. Then I'm going to copy this format to the other current assets I've already got: accounts receivable, office supplies, and prepaid insurance and rent. So office supplies, accounts receivable, prepaid insurance, and prepaid rent. Okay. What do I have left to account for on the balance sheet? Well, there seem to be still a number of items. So I have an intangible asset here, and I have an intangible asset here. So let's go to the next category of assets and add those into the intangible category. The first one I need is website design, and the next one was business license. So we'll just copy those formulas to the right. The reason they look peculiar, I just realized, is because I'm copying the cell, including the formatting. So let's reformat these this way. And we'll add up the all the items above it. So our total intangible assets are $1,060. Now let's go back and what's called clear those items off the list by highlighting them. So I'll take one balance sheet format like this, double click on the format painter, apply this to website design, which you can see was an intangible asset, and the other one was business license. Okay. Now, if I cast my eyes down this list, I notice that there are no assets that have not been picked up. So this means I can now complete part of the balance sheet by ending up with total assets. So let's add in a line here for total assets. And I probably should have one for total intangibles. So the total assets are simply equal to the sum of the different subcategories of assets. So that's total current plus total intangible. Total assets are $24,261. So that is the left side of a balance sheet in book format. It's also the left side of the basic accounting equation. Now we need to populate the current liabilities section. So let's go find some of those. While I do this, to make life a little bit easier, I'm going to hide some cells, some columns, so that I can be closer to the data. Okay. All right, so I'm going to go down the balance sheet looking for anything that is a liability. I'm going to highlight some more, hide some more cells. There. Now I can see all of this data. Okay, running down here, looking for unhighlighted green checks. Here's a current liability, income tax payable. Here's another one, deferred revenue. And here's another one, accounts payable. Usually the order for these is accounts payable, followed by deferred revenue, followed by income tax payable. The order of the items listed on the balance sheet under current assets and current liabilities is conventionally listed in the order of liquidity. So the most liquid items, those that have the cash impact the soonest, are listed at the top. So for current liabilities, it's going to start with accounts payable, then it's going to be deferred revenue, then it's going to be income taxes payable. All right, with those captions, I can pick up the amounts by simply copying through a drag operation to the column to the right. Okay, and I'm going to format those data with commas. And that I know now is the total of my current liabilities. So I'm simply going to add them up using the sum formula, and I'll format it with 2 lines. And then I'm going to go back and clear those items by highlighting from the list that we were given using the format painter. So I've picked up accounts payable, deferred revenue, and income taxes payable. Let's see what else we have left to pick up on the balance sheet. It seems we only have owner's capital. So that we know is an element of equity. We've signified that in our earlier analysis here. So we'll go down to equities and we'll pick up owner's capital. And the amount is $20,000. I'm going to format these amounts using the comma format. Now I'll add them up. And the total shareholders, the total proprietor's equity here for the lawyer Shalini DeVinto is 20,177. So I'm just going to copy this total assets caption and then edit it. So we have total, these are total current liabilities. They're also total liabilities. So we could put either caption in here. And this, of course, is total equities. Your textbook tends to use the singular equities. I'm used to calling it in the plural total equities for reasons I'll explain to you in class. Now, the other thing we need to be able to check that our balance sheet actually balances, let's make this uppercase, total assets, and then we'll call the next line here total liabilities. Sorry, total liabilities and equities. All right, and this, of course, is equal to the total of the liabilities plus the total of the equities. Sorry, do that again. Total liabilities plus total equities, as the name implies, and we'll format that with a heavy bottom border. And what we need to do, of course, is check that the basic accounting equation represented in the balance sheet still holds. So our total liabilities plus equities equals our total assets. So we know at this point that we have completed the balance sheet in a way that balances. And since we just picked up the owner's capital, we'll clear that item. And we can run down the column of the balance sheet and observe that we have accounted for every single item that we previously analyzed belonged on the balance sheet, and we've allocated it to the proper element and subclassification. All right, the last statement we have to prepare is the statement of cash flows. We have, I think, 4 items here that we need to account for. We see one is financing, one is investing, and these 2 are operating. So let's pick up the operating items first. We'll deal with cash receipts from customers, which sounds like the movement of cash. And then we'll pick up on the next line, cash payments to suppliers. Okay. Then we could copy those formulas, over to the next cell. But we have to just check one other thing to make this statement accurate. And if we look at where these are coming from, the operating activities, we signified that this was a positive cash flow, meaning it's cash flowing into the enterprise. This was a negative cash flow because we're paying suppliers, cash is flowing out of the enterprise. So in the cash flow statement, it's conventional to show positive cash flows as a positive number and negative cash flows as a negative number. To do that, I need to put a minus sign in my formula. Okay, and now we can see that there is a negative there. Then we're going to have our total, our cash flow, cash, we can call it provided or consumed by operating activities. Okay. We'll just add that up. In this case, you can see that we actually have a net negative cash flow from the operating activities. So that would be cash consumed by operating activities. In terms of investing, let's go and format those as being dealt with. So we had cash payments to suppliers, and we'll just highlight the check mark as well. And then we can copy that format to the cash receipts from customers. That leaves just 2 items. The next one is the purchase of intangibles. And if we look at our analysis of the purchase of intangibles, we noted it was an investing activity with a minus sign, which means it was a cash outflow when we're purchasing long-lived assets. So we need to modify this formula, which remember I obtained by copying the formula to the left. We need to put in a minus sign to show that it's a cash outflow. All right, so let's copy the formatting from another cash flow item to the purchase of intangibles. That leaves us one item, which is cash contributions by owners. That is a financing activity. We'll just, before we copy the formula, we'll note that it was identified in our analysis as a positive cash flow. That's the significance of the plus sign. So I'm just going to copy this reference formula to the right. And then I'm not going to do subtotals for these because there's only one item. So I'll just put a line underneath. Actually, I'll change my mind here. Because we've used this cash provided or consumed by, let's also add that and we will create a total. So this is cash provided or consumed by investing activities. And this one is cash provided or consumed by financing activities. All right. So I will make a subtotal here. And I'll make one, I'll just copy this formula down below. I'll make one here as well. I'm going to format all of these using the accounting format. Actually, for mine, I think I can do it with just commas. Yes. So for me, the way I've set up my formatting, when I use the comma format, my negative numbers show up as brackets. So one of the things I'd like to just stress at this point is that using the brackets for negative number formatting makes it very easy for us to interpret the direction of the cash flows. Now, to complete the cash flow statement, it completes in a continuity format, much like the statement of retained earnings. The first item we need is the net cash flow for the period. And that is simply the aggregate net cash flow of each of the three types of activities. So that's the sum of the cash flow from the net cash flow from operating activities plus investing activities plus financing activities. All right. Then this is where the continuity comes in. We need a cash balance beginning of the period, and that will help. We'll add that to the cash flow to get the cash balance at the end of the period. Okay, cash balance ending. And if we've done this correctly, the ending cash balance on the statement of cash flow should agree with the cash balance up in the top of the balance sheet, and we can see that it does. So let's just clear this item. Let's take this row for formatting. And we'll clear this last item because we included it in the financing activities. And if we cast our eye down the cash flow statement column, you can see we've accounted for everything. If we cast our eyes down columns B and C, you can see every item we were given has been accounted for, which means we've placed it in a financial statement. We've also done some checking that the statements articulate. In other words, the balance of retained earnings. Let's unhide the cells that I previously hid. We saw, for example, that the net income flowed into the statement of retained earnings. The ending balance of retained earnings flowed into the balance sheet in the equity section. And we also saw that the cash balance on the balance sheet was identically equal to the ending cash balance from the reporting of cash flow activities on the cash flow statement. So that's how we can quickly create these financial statements. Now, I'll spend just a couple of minutes to identify or to assess performance and position. So financial performance is about assessing an enterprise's growth, profits and profitability, and its cash flows. And this is the first period of operation. So we are unable to assess growth because there's no prior period to compare it to. What we're left with is a profit of $177, which we can also calculate as a percentage of our revenue by dividing the net income by the revenue and expressing that as a percentage. So how can we evaluate this? Well, the best way to evaluate it is to compare it to something, but we really have precious little to compare it to because we have no prior period of operation. We don't have available immediately at our disposal any financial statements for other sole proprietor legal practices. So we really can only evaluate this on the basis, let's say, of our needs and some general rules of thumb. In the textbook, it indicates that many businesses operate with a bottom line net income that's 10% of revenues. Now, I think that's a bit of a broad brush statement that really applies to more of industrial enterprises rather than professional service firms. But in this case, one of the things that we could do is you can imagine if you were a lawyer and you started your practice and you had your first month and you generated a profit of $177, you'll notice nowhere in the expenses was there any salary, wages, or benefits for you as the owner. So this $177 is your income. And one way to evaluate this is, could you live on this amount? I seriously think not. So this is actually a very low level of income. It's very poor. And income as a percentage of revenue at 3% is also very poor. With that evaluation, the owner should be looking at their statements together with their financial accountant or advisors and figuring out what they can do about it. And of course, the main way to improve this performance is to provide more legal services and generate higher revenues. That's the first order of business. Now, we can also evaluate performance on the basis of cash flows. So we go to the cash flow statement for that. And we can see that operating activities were actually a drain on our cash flow. We also used up some cash in investing in, I think, our website and mostly the website. And then how did we cover these various cash outflows? By having the professional owner of the business contribute their own capital of $20,000. So it's their original contributed capital that's funding the startup of the business, their initial weak operations in terms of income, and their negative cash flow from operations. So this is also a poor cash flow. The only reason that we're able to cover the startup cash flows is because the owner has put money in. This is very common, actually, for startup operations to not hit the pavement running and generate immediate profits that are large and immediate positive operating cash flows that are large. However, this professional practice cannot continue to operate on this basis, otherwise they won't have a business survive. All right, so how do we evaluate financial position? For that, we go to the statement of financial position. And here we can compare our current assets, which are $23,000, against our current liabilities of $4,000. This is a healthy margin of safety, which essentially means that we've got a really strong and adequate and sufficient set of current assets that will either be cash, $18,000, or soon become cash, such as accounts receivable, giving us the resources to pay off all the liabilities we have, accounts payable, income tax payable, and then next period, we will provide the services that are necessary to be able to earn this revenue. So from a liquidity perspective, which is the ability of this business to realize its current assets to satisfy its current liabilities, I would say it's very healthy. And of course, a lot of this cash came from the owner's contribution of $20,000. We don't really have any long-term liabilities for this business, so solvency is not an issue. And the equity section of the balance sheet shows that most of the capital financing, liabilities and equities, is coming from the owners. So it's in a fairly healthy financial position. In other words, it has a strong ability to carry on, but it really needs to pay attention to generating some sales revenue keeping control of its costs and expenses, leading to the generation of more profit and hopefully an improved cash flow from operations. That's it for this week's office hours video. I hope you find it useful, and we'll see you next week.